Hello, welcome to the August 21st edition of Market Outlook. This is Jeff Bish, president of MarketGauge.com, filling in for Keith this week. All right, so let's jump right in beginning with the weekly situation in IWM. The markets sold off this week, and there was a whole bunch of political turmoil. However, we're just going to focus on what to look for to determine whether or not the weakness in the market is going to continue, where some of that weakness is coming from, and whether or not there's an indication late last week that the markets are kind of done going down. But first, let's make sure we know where we stand. And the best illustration of that, I think, is IWM, as this has been the weakest index coming off the highs. I'm looking at it on a weekly chart just to get the big picture. And the big picture is one of sitting at some pretty important support levels while breaking several others. So I want to make sure you take notice of the trend line going all the way back to the bottom in 2016. This was broken last week, and the break of that line was confirmed this week with further weakness below that low. Also, as I know Keith has been pointing out, there's been a really nice channel. In other words, draw a line across the highs and then pull down a parallel, and that channel has done a great job at defining the lows of the IWM over the last several months, really for the whole year. That was taken out this week rather decisively. Now, I actually feel that the most important points to look at are the actual price swing highs or swing lows. And that's where the biggest support argument, I think, comes in. The blue line here, the moving average, is the 50-week moving average, so basically equivalent to your 200-day moving average. And you can see that IWMs are right down into kind of the beginning of this support area. The dotted line represents not necessarily the absolute lows, but a line that represents several lows in an area, therefore, you would expect that the market might begin to dig in. So we're sitting right on top of the dotted line, but I would say the zone that we're going to want to watch this week on the downside is all the way down to the black line. That's about 132.40, if I remember correctly, is the absolute low of the range that the IWM has been in. So from a bigger, just kind of crayon point of view, I would draw the most important range as being right here. We're down towards the lower end of that. So the question is, now let's look at the other markets. Let's look at some of the stuff that alerted us, and Keith was right on top of the market gauge in big view turning negative earlier a couple weeks ago and at the beginning of this slide. So let's take a look at where that stands and a few other indexes and figure out what to expect next. So in order to do that, let's first go to the daily chart on the SPYs, because the daily chart here on the SPYs looks awfully weak. It looks awfully weak in the context of having taken out a swing, the prior swing from last week, and breaking decisively below the 50-day moving average. Now, we've broken below the 50-day moving average several times and still maintained the uptrend. So the question here is this break going to continue lower, and what should we look at to try and determine that? I want to take or point your attention to a few of the situations that we monitor in our Big View tool. So our Big View tool can be found under Tools in Market Gauge. So if you go to Tools here, then you'll find Big View. That's where I am here, and I'm in the free section. This is the gauge that alerted Keith a couple weeks ago that the market was potentially in trouble, even as it was moving higher. The gauge turned red. You can see a week ago it was red. You can see a month ago it was red. Now, to make this really simple, if it's red, it means risk off. If it's green, it means risk on, and risk off means expect some trouble in the market. All right. Now, I want to take you to sector summary first. And the reason I'm taking you to the sector summary is really twofold. First of all, we did a special training this week on the power of focusing on leading sectors. In fact, I shared a completely automated trading strategy that focuses on trading the leading sectors. If you haven't seen that, I'd encourage you to. I will probably put a link to that training below this video. But the sectors will also give you another view at the strength of the market. And that view in this sector summary page is there's an indicator you won't find anywhere else. And the key here is that we're taking the number of sectors that we're following in the table up here, and we're keeping track of how many of them are positive on a 6-month basis, right? And that number tends to give you a good indication of the overall health of the market from an industry group point of view. Now, as you can see from the raw data, the majority of these industry groups are still positive on a 6-month basis. But when you look at the numbers in detail, you will see that some of them are getting pretty close to that red level. So we want to pay attention to this, and then we want to look to see if the pattern is developing of deterioration as the market moves down, and how we look at this point in the SPYs relative to prior pullbacks. So when the market pulled back to its 50-day moving average here, we had almost 14 sectors positive. All right. When it pulled back here, we were at the 12 level. When it pulled back here, we got a little weaker. We were what looks like at about the 9 level. Now we've pulled back and we're at the 10 level. Now, this doesn't scream red alert necessarily, and this indicator isn't going to be a very precise market breaking point. But what we can see here is that we are losing some group support here. And as I just pointed out by the low numbers, there's a good chance if this continues to move lower, these numbers will fall off a cliff pretty quickly. Now, historically, I've focused on this to tell me whether or not the 200 is going to be some support. However, as you can see here, the breakdown or the deterioration, it looks a little ominous. So I would keep an eye on this chart as the market pulls back, or more importantly, one of the indicators that the market has just gotten flushed out and it's going to explode higher would be that if the SPYs were to come back, take out this 244, and you see this number really climb. Right? That would be one of the things I'd look for over the coming weeks for a positive indication if the market goes higher. If the market goes higher and this continues to go lower, then I would be extremely nervous. So let's take a look at some of the other indications that kind of led to that gauge turning red and led to Keith pointing out that the market was getting weak. So I'm sure he showed you this in the prior videos of Market Outlook. The key here was on this key ratios page, we're looking at the relationship between different instruments and the S&Ps or interest rates. Essentially, if the red line is trading under the other lines, more specifically the black line, it's a warning sign. Now, it's a warning sign for stocks, i.e. risk. That turns red, almost all of them turn red, at around the beginning of August. They're still all red. So the markets are going down, or the stocks are going down, and there isn't any indication from how the stocks are trading, interest rates are trading, gold versus wood, how any of these are trading relative to one another that would suggest that the risk-off environment is changing. Keep an eye on this. If the markets continue to sell off or even go sideways, but all these ratios start to turn higher, then that would be potentially an early indication that the market has reached a point where it's ready to go back up. But for now, it still looks pretty negative. The other ratio or market internals that I think are spelling, and I'm going to go to market internals, which right now unfortunately is not part of the free area, but I want to give you the benefit of the information here. So the new high, new low ratio. I'm a big fan of looking at new high, new lows and whether or not they're getting better or getting worse, and that's really the big indication. One thing that you can look at is whether or not the markets get flushed. Flushed in this would be, 400, 500 new lows. We're nowhere near that, and that would only come about with a major decline. For right now, let's just focus on the deterioration. So the black line is a 10-day moving average of the ratio of new highs to new lows. That number crossing this 70 level is typically a warning sign. So it crossed that level this week, and its trend is still down. This means that from a new high, new low perspective, the market is in a very weak state. Now, to further that, if you look at the absolute number of new highs, new lows, we're below 100. We should not be below 100. That's not healthy. And the trend here coming off the highs has been, if you'll notice, when the market made the new high, it made fewer new highs, and it quickly had more than 100 new lows. So that's an indication that the market internals were weak right from the beginning of this sell-off. So again, kind of along the theme of what I've been saying, the market has been deteriorating, and now it's breaking that key level of the 50-day moving average. Let's take a look at the same number in NASDAQ, and you'll see that that's actually running ahead of the SPYs. In other words, the NASDAQ's 10-day actually crossed closer to the beginning of August, has been trending down ever since. So NASDAQ's in the same situation, and it sitting on its 50-day moving average. This kind of number would indicate if this breaks, the deterioration has already begun, and more weakness is likely, I should say, to ensue. So the bearish case here is that the market's pulling back, and the market internals are still negative. They're not completely oversold. And if IWM breaks below its key levels that I pointed out earlier, it's going to be in an extremely negative situation. All right, so if IWM continues to break, it's a major break, and it would be happening right along a significant break, that of the 50-day moving average of the SPY. If we look at the Dow, sitting right on its 50-day moving average, further weakness in the market would have it breaking its 50-day moving average. And if we look at NASDAQ by the Qs, it's sitting on its 50-day moving average, so a break of that would have everything breaking significant support levels at the same time. That's the bearish case. Now, here's what I want you to focus on, though, especially in the beginning of the week. With all the negative news that came out in terms of Trump's administration, and with the negative price action that we saw in the markets this week, Friday was a really interesting day in terms of the markets potentially signaling that they weren't quite ready to go down yet. And I get that from the fact that the SPYs broke down. This is a major breakdown here. And they followed through on Friday in terms of price, but they didn't really follow through. So SPYs really couldn't look more negative right now, but at the same time, the Qs have held. All right. So that divergence suggests that if we start to head higher on Monday, head higher would be, the first sign of heading higher would be trading over Friday's highs, and I would look for the market to be trading over Friday highs in all of the indexes, at least the SPYs, Qs, and IWMs. If they do that, could be an indication that Friday the markets decided enough was enough. Now there's another reason that I'm suggesting that this could be the case, and that's because if we look at the VIX, while the SPYs made a new low, did not make a new swing high. All right? In fact, the VIX was relatively muted. That's not what I would have expected going into a weekend with the SPYs trading at new multi-week lows under the 50-day moving average. Additionally, the TLTs. So the TLTs broke out to a new high as for this move, as I would have expected with the SPYs breaking down, as that would be a run for safety. However, as the SPYs settled in, the TLTs actually sold off a little bit. I would have expected the TLTs, just like the VIX, to be stronger if the market was really fearful of the market going lower. And finally, same idea is gold. Right? So gold got off to a positive start, which would indicate that the market's nervous, but it came back. So again, going into a weekend, the market really didn't seem to be nearly as nervous as it was at the prior break of the 50-day moving average. Now, to sum all this up, the market's weak. The market's still going down, but it's at a critical level of support on every index, with the exception of the SPYs, which have broken down. But there's a divergence, and the divergence isn't just in the SPYs and the Qs, for SPYs versus the Qs. The divergence, in my mind, is in the fact that the assets that should have gone higher on Friday, if the market was really worried about a big decline this week, didn't. So if we continue to go lower early next week, extreme caution. We're definitely in a situation where we could see significant declines. However, if we start to bounce, the market might be ready to bounce. I gave you the stuff I would look at to see whether or not the bounce is actually going to turn into an up move or just a bounce. Hope that helps, and I'll see you in the next video.